Everyone is able to join. Just 10 seconds and we shall start. All right. Good afternoon, ladies and gentlemen. My name is Aisha Abbas and I head Affluent and Wealth Solutions here at Standard Chartered Bank. Thank you for taking the time to joining us during these unprecedented times as we are seeing in front of us some of the developments here in the Middle East. First of all, I would like to wish all of you well-being and safety. Hope that you're all well and keeping safe. As developments continue to unfold across parts of our region, as I said, our focus remains on the safety and well-being of our colleagues and, of course, our clients, as well as the ongoing stability of our operations. Let me assure you here that our operations at the bank remain resilient and we continue to support you without any disruption. We at Standard Chartered are here to be your trusted partners and help you manage your wealth in a way that is aligned with your objectives, time horizon, and risk appetite. Of course, during times as this, there is always that uncertainty, that anxiety that comes through. But what is important is to stay true to your core portfolio, to your core strategic objectives that had been set to grow and preserve your wealth. But at the same time, look at what are the immediate opportunities that are in front of us and what are the challenges that we also face so that we can help navigate through these times. So with that in mind, we were really keen to gather with you virtually today and to keep you apprised of the impact that these recent developments have had on the markets and, of course, reinforce our commitment to you. Both myself as well as Pratibha, who heads our investment advisory and managed investments, together with Manpreet Gill, who many of you know and have met before, our Chief Investment Officer, alongside your relationship managers and investment advisors, are here with you to take your feedback, to listen to your questions, and answer as many questions as possible. As I said, we are meeting here virtually, but as circumstances evolve, we will continue to host webinars and at the same time aim to meet you face-to-face as well. So please feel free to reach out to your relationship managers, investment advisory teams, and all of us here at Standard Chartered who are here for good to support you. These are unprecedented times for some, and therefore we thought it'd be important that we get together and talk to Pratibha and ask Manpreet some of the questions because they get first-hand information from Standard Chartered Group CIO office, just to help us navigate on how things are, where are the rates moving, how are the equity markets behaving, how are the oil prices going, how is this going to impact interest rates, what is the immediate impact that it may have on your portfolios, and should you have excess cash positions, what is it that you should be doing with that? And if you have cross-currency exposure, then what kind of currency plays that you should be looking at, and what are the asset classes that are of interest at this point in time, and how are they being impacted? So there's lots and lots of questions that come to mind, and therefore we thought that we get together and answer some of those questions. I know some questions will be coming through on this chat also that we'll take up. Pratibha is separately receiving questions as they're coming through to the RMs and investment advisors from yourselves. So please keep getting them on and we'll try and answer as much as we can and be there for you. So without further ado, I'm now going to pass on to Pratibha, our head of managed investments and advisory at EMEA for Standard Chartered Bank. Pratibha, over to you. Thank you.
Thank you very much, Aisha. That was a fantastic start to this, and thank you everyone for being here with us today. We know the world feels a little bit uncertain right now, and much of that uncertainty is, of course, centered here in the Middle East with what's happening here. We're bringing this to you from Dubai, and so we really are very close to the action. I do understand there are investors across the region from EMEA And we hope to answer most of your questions in today's webinar. But what we intend to do right away is to start off with a few of our questions that we've already started receiving, to which Manpreet is going to kind of set the tone in terms of what we're thinking of the current situation. And then, of course, please feel free to post your questions in the Q&A chat box in your Zoom app, and we'll pick it up as we go along in this hour-long session. So, Manpreet, once again, thank you very, very much for your time and for being here. To set the stage for our audience this afternoon, how would you characterize the current situation in the Middle East? Can you walk us through some of the scenario tree, so to speak? What could it mean from a de-escalation perspective, contained escalation perspective, or a broader regional spillover? And what are our thinking around it? And if you also can share some comparisons to previous episodes when regional instability has reared up in the past decade or so. Thanks.
Thanks, Pratibha, and good afternoon, everyone. We hope you're all staying safe where you are. But today, actually, since we're here to discuss, obviously, the financial market implications, I think it's important that we also try our best to put on, a more rational and market-driven lens compared to obviously what many of us, I'm sure, are experiencing, from a personal level. But I think from in terms of what's happening in the region, I think when we see geopolitical events of this type, right, whether it's from the Middle East this time or elsewhere, the number one question we ask ourselves is to step back and say, look, what's the channel back to financial markets? And in this case, you don't need me to tell you that it's, of course, oil prices, energy prices more broadly, including natural gas. But I think centering sort of on its focus and potential fallout on broader financial markets by understanding that channel is what I'd say is perhaps one of the more important things, and to us, really the best starting point. Because, geopolitically speaking, you can go in many directions, and I'm sure there are many better analysts out there, but I think from a market perspective, financial markets often have a much narrower focus. Now, maybe two areas I'll sort of address briefly, right, in response to your questions. I think one is the historical perspective, right? There are many comparisons whenever there are events in the Middle East to the 1970s, but those I don't think are fair, right? The 1970s was a very different world, a much greater concentration of crude oil supply from one region alone, and more importantly, a much, much greater share of individual, wallet share of spending on energy prices and related products. So, the world is a very different place. Your electric car does not need fuel. So that's why we've seen the sensitivity to some degree reduce compared to the 1970s comparisons. But last year, we did have another sort of regional conflict, a short-lived one. And I think that's perhaps been a great example where we did see a short-term sentiment-driven jump in oil prices. But once we got through the crisis, actually went back to the world of a heavily oversupplied oil market, and oil prices pretty much did a full round trip back to where they started, to a range of around $60 per barrel. So I think that perspective is also important. And I think what it tells us is that, how much prices rise, and more importantly, how long energy prices stay high is actually quite important to whether there's any lasting impact on markets or not at all. The second thing is, I think the way we're sort of trying to frame this current environment is just thinking in terms of scenarios. Because obviously it's a rapidly evolving situation. We see new headlines every couple of hours, but we think, having sort of some scenarios at hand helps navigate that environment, because as you get a new piece of information, you're able to slot it into, okay, which scenario is this starting to point us down the direction of. Now, on scenarios, our baseline scenario is still one that, this conflict, of course, does, disrupt energy, supply, but only temporarily. So in other words, for weeks rather than months. And that, of course, suggests an environment where prices, of course, on the weekend, on Friday, we had actually set such a scenario point to oil prices heading to $80 temporarily. And I think on Brent, we're already there. But if this is weeks rather than months, then the long-term impacts in terms of, raising inflation or raising costs for emerging markets, those don't really play out at a full year level. So you can have a short-term sentiment-driven pullback, but usually not more than that. Now, around that long-term sort of scenario, obviously you have the upside scenario, which is that we end up back at the negotiating table quicker than we all expect. That's a scenario where oil prices are very quickly back to a $60 range. But there is the downside scenario where, disruption and hence high above $80 per barrel prices remain in place for a much longer period of time, so months rather than weeks. And I think that's a scenario where you need to watch inflation very carefully and see whether there's a more long-lasting impact on markets. But I think having the scenario sort of way of thinking, in our base scenario that it's weeks rather than months, I think sort of helps put some sort of framework around what's happening, and hopefully helps navigate the screaming headlines that we're all being subject to.
Thank you, Manpreet. That kind of sets the tone, right? And we've kind of seen that the markets are more or less seeing it similarly. We didn't see a lot of panicked reaction as of yesterday, of course, other than oil. But that just brings me to this point around some of the details around this region, right? So as we all know, the Strait of Hormuz carries roughly about 20% of the world's seaborne oil. How are you thinking about the tail risk of any disruptions here? And what's the base case for oil prices through the rest of 2026?
So I think our base case, as you described, is still one of oil prices that short term are sort of in the $70 to $80 range. But ultimately longer term, which means on a full year basis, still return to a range around $60. And it comes from the macro scenario, sort of scenarios around how this current sort of events might pan out, right, from an oil market perspective. But what's happening on the Straits of Hormuz, of course, is it's sort of one of the levers sort of going into what might define one of those scenarios. Because as I'm sure it's quite widely known now, whether you're looking at oil or you're looking at natural gas, in the region of approximately 20% of global supply sort of is shipped out through that region. And I think we need to keep a close eye on obviously shipping. The Strait of Hormuz is one area, but of course, production and storage and the entire supply chain is of course quite important. So I think all of these are things we need to watch. But I think the feedback into the scenario and come back to the crux of the argument, which is how long do disruptions remain in place. I think that's still going to be the single most important thing, because while there are a lot of headlines around the Straits of Hormuz, I think what we're missing in that is, yes, that can lead to a knee-jerk reaction in prices, but the length of any disruption, how persistent it is actually going to be more important when you think about the fallout, either for inflation in the US or for large oil importers across many emerging markets, particularly in Asia. So that's really, I think, the factor that we'll be keeping a close watch on.
I think that's a great segue into my next question. It was around inflation and the point around, if this were to be continued situation and oil actually goes over 100, history has told us that, if it goes over 100, inflation normally picks up by about 0.6, 0.7 percentage points. What is our understanding of, how that could kind of mean from a central bank policy paths perspective, specifically from the US or even Europe for that?
So actually, it's a really good point, right? Because inflation to us is how, a risk from oil prices because of what's happening in this region can potentially spread in a downside scenario. Right? Because, if you think about oil prices, right, higher oil prices are a bit like a tax. For importing countries, obviously it is through the import channel. But for the US specifically, there is a high correlation with inflation, or at least expectations, market expectations of where inflation is likely to go. Now, as you might already know if you've been following our views, right? Our views as we publish in the annual outlook is that we think the Fed has room to cut interest rates. And that's driven primarily by a view that inflation, is not a challenge, that it continues to move in the right direction, and thus allowing the Fed to really focus on what we still think is a relatively soft US job market and to cut rates, another 2 to 3 times this year, which we think will bring policy back to a more neutral sort of space. Now, link it back to the scenarios. If the jump in oil prices is relatively short-lived, then one would expect that impact on inflation or expectations of inflation to be relatively short-lived. But if the rise is more sustained, whether we go to 100 or beyond that, I think where we really, would end up seeing it potentially become a challenge is in market expectations of inflation in the US. Because in that scenario, you start to raise questions about, whether the Fed is indeed able to cut rates as we expect, or whether they need to hold off to avoid, another inflationary surge. So again, when we talk about the channel back to financial markets, oil prices, yes, but I think when it comes to an economy like the US and what it means for policy and hence what it means for, policies implications across other asset classes, watching those inflation expectations, I think is really quite key because that's where we most probably first see, some of the impact show up.
Great. So, I mean, again, circling around inflation, and I'm sure a lot of our clients have these questions as well, right? I know our base case scenario has been for a soft landing, but there have been geopolitical strategists, especially now that there is so much geopolitical noise, that are saying that 2026 is far from Goldilocks and investors should position for structurally higher inflation, but at the same time, lower growth. Do you agree with this framing, and how is that shaping our asset allocation?
So I think when we talk about structurally higher inflation, right? Look, if you look out over the next few years, that's potentially possible, particularly coming off, I guess, the last few decades, inflation has been, relatively low. But I think the extent of inflation is quite important here, right, for your asset class decision, because, when we did this analysis in the past, what we learned is that there's quite a big difference between what we characterize as, let's say, high inflation. So in the US economy context, that means, let's say, inflation in the 2 to 4% range versus extremely high inflation, where you see inflation go well above 4% to the 7, 8, 10%, which of course can be quite problematic. Now, I think when you think about the asset class implications, right, in a 2 to 4% sort of high inflation scenario, actually equity markets can do quite well. Because you tend to have, equity returns ultimately linked to earnings growth of underlying companies. And in a moderately high inflation scenario, high inflation, to some degree, those prices do reflect through in earnings. And I think that's obviously not the only reason why we like equities, but our preference for equity markets, overweight, at least from the start of the year, which continues to hold in our base case, is driven by ultimately expectation that earnings will continue to offer support. So in a scenario where inflation remains a little bit on the higher side, that's a scenario where equities can actually still do very well and indeed offer you more protection than, let's say, a fixed yield asset class bonds. But there are also other asset classes, right? So gold, many would know, we're still overweight. Many reasons behind that. The primary one being that emerging market central banks continue to purchase gold at a pace we haven't seen since the 1960s. But in a world of high inflation, in gold and maybe other commodities are, of course, another sort of asset class that historically has tended to offer some protection against higher inflation. So I think even a world of moderately high inflation, yes, we should protect against that. But I think that's already well incorporated in sort of our baseline views. And why we think that little bit of a balance to more growth assets, more equity-like assets, that's still important, regardless of portfolio types.
No, that's a great overview, right? I think we'll come back to the inflation piece, but I already have started seeing some questions around it coming up. But, that's a good segue into the asset class views. So from a equity perspective, and they've typically shown resilience through multiple geopolitical episodes in the past, and especially in the Middle Eastern context. Is this time any different? And also, does this change our view on US versus Europe versus emerging markets?
So at the moment, no, right? And I think, look, when you talk about some of the risks in the short term, we'd rather be hedging than changing some of our long-term allocations, right? Because if this jump in energy prices, doesn't last beyond a few weeks, then we think it would be an error to, respond excessively to those long-term allocations. But from an equity market perspective, look, we still think that overweight is justified, but the regional question is a good one because our current stance, as many of you might know, is that we like actually exposure across the board to US and non-US equity markets, but our overweights are concentrated on US equities and in the non-US equity space on Asia ex-Japan. Now, some of that is linked to our view that the US dollar will get weaker, and I think that's where we do think having a reasonable amount of non-US exposure in the equity space makes a lot of sense, right? Our preference might be in Asia ex-Japan, India and China in particular, but actually even those small allocations to Europe and Japan in long term are interesting. And if we see a bit of a pullback in the coming weeks, that may very well provide an opportunity to build some of that exposure if you don't have it already. But to the point on diversification, right, I think the US equities may actually help offer a little bit of that balance, especially in the short term, because if we do see the dollar as a bit of a safe haven, you combine that with some of the pause we've seen in sort of the AI theme, the technology theme, that of course can outperform in the short term, even if this period of stress continues. So I think owning a reasonable amount of non-US equities we think is important. The world is a very different place to the last, let's say, decade or two when US equities actually deliver the bulk of your portfolio or equity market returns. But for now, I think our stance is about making sure there's a good balance between both. And in the short term in particular, I think if we see the dollar continue to behave like a safe haven, that can support, US equities for the time being and potentially open up an opportunity to build that non-US equity exposure where you might be looking to do so.
Nice. So I think, base case that I take away is that definitely add equities to the portfolio. These are volatilities that you can actually possibly take advantage of course, meaningfully in the sense that, you wait and watch, but deploy carefully over a period of time. But equities should be a part of the overall portfolio. Get that. Thank you. Just moving on to the next big asset class where we see a lot of interest normally, right? What is our view on credit market implications? Especially for the MENA credit, given the situation here, and also, spread behavior during risk-off situations.
So I think when you think about credit spreads, right? So in other words, the premium you're paid over government bonds to on corporate bonds, emerging market bonds, look, they tend to behave like risky assets. So if we do see a pullback in equities and equity-like assets, it would be natural for those credit spreads to widen and sort of corporate emerging market bonds to underperform US government bonds to some extent. But also, let's not forget that we're coming off a point where corporate bond valuations have at extremely elevated levels. So a little bit of a pullback, if anything, would be welcome and maybe reopen a window where investors will be looking to find a little bit of value, which has been quite hard to find in recent months. I think on the two areas you mentioned, I think one is I just highlight that emerging market bonds as a whole, we are overweight. Now, many of them tend to be oil importers, so we may see a bit of a pullback in terms of credit spreads in response to this higher oil prices. But at the end of the day, we still think they're a good, group of credit bonds to add to the mix because they help add a little bit more value and yield to a portfolio that owns otherwise a lot of investment-grade government bonds. The second, to your point on GCC credit specifically, right, because it seems in the eye of the storm. Look, let's not forget that these are fundamentally, extremely strong or high-quality credits, right? And maybe even more so than the broader emerging market universe, because of that strong credit quality, have been extremely expensive from a valuation perspective. So, it would be natural for there to be a little bit of credit spread widening. But I think because of that credit quality being so high, if anything, the widening we've seen has been a little bit more muted than one would expect. And let's not forget, for many of the larger sovereigns in the region, the scenario of higher oil prices actually helps lean against some of the challenges because it helps bolster fiscal revenue. So to me, obviously each portfolio is different, but if you're looking for an opportunity to add, a window where credit spreads start to widen for GCC credits from what are still fairly expensive levels to offer a little bit more value could be one of the opportunities we get out of this current sort of scenario.
Thanks, Manpreet. Just maybe moving on to the other spaces, right? So beyond oil, we've covered oil to some extent. Where do you see meaningful moves? I know gold has been, strengthening quite significantly over the last few quarters, but, in the last few days, we haven't seen it spike as much. Maybe it's priced in. But also from a currency standpoint, how do you size these exposures from a USD, CHF, JPY? These are all, safe havens as we know them. How do we size these without really over-hedging?
So I think it's a good point, right? Because what you discussed, I mentioned a whole bunch of potential hedges, particularly in the short term. But the key is, hedges should not become the overwhelming component of a portfolio, right? I think we are not fans of excessive concentration. That should apply, to most sort of asset classes. So gold, for example, like you said, an asset class we like for a variety of reasons, but in the short term, particularly, it's benefited maybe to some degree from what's going on, but of course, it has already done very well. And that's an asset class where, our balanced allocation, for example, has about a 5-7% allocation to gold. So that sort of helps from a sizing perspective. But I'm glad you brought up currency because that's the other asset class where we can see safe haven moves or we may see the emergence of some opportunities. So I think the dollar we spoke about a little bit. I know it's only been a day and a bit, but we have seen the dollar sort of emerge a little bit to behaving like a safe haven currency. And again, that could be coming from its traditional safe haven role or slight scaling back of rate cut expectations from the Fed. But that's one role, of course, which could offer some opportunities long term to buy into our structural view that we expect the dollar to get weaker assuming our base case holds, of course. But when you think about other currencies like the yen and the Swiss franc in particular, these are currencies that are also traditionally viewed as safe haven go-to currencies. Now, I think again, we've seen a more muted reaction than what one would normally expect. In the case of the yen, I think because there's a lot going on in Japan in terms of just what pace the central bank would like to raise rates, and of course the government's very strong fiscal plans. But we do believe at some point over the next 12 to 18 months we might get considerably stronger yen. And also the Swiss franc, right? Because the Swiss franc, our view has always been that we go towards 74 cents dollar Swiss over the next 12 months. But we have seen the dollar Swiss strengthen quite a bit, both year to date, but also over the past 1 year. And I think that, a bit like gold, is what's resulting in a strengthening move, but one that's been more muted. But on currencies in particular, let's not forget currencies are quite volatile. So if anything, we would not want to get excessive concentration there. I think the more diversified one's currency risk, the better. I think that's a perspective, regardless of how you're implementing it or using it in portfolios, continues to be very, very important.
That's a very key point, right? And I think we'll talk about it a little bit more. I see a number of questions around currencies, but just one quick deviation. And I know this is something that we don't necessarily cover a lot, but we've spoken a fair amount on oil, but gas prices have shot up massively as well. Will that impact euro and the European economy, equities largely? What's our view on that?
So I think the regional exposure is a little bit different. So you're right. I think in terms of potential impact, I'd be looking to the impact on Europe and also to many large Asian economies as well. Both are large sort of users of gas and potentially source from the Middle Eastern region. But its argument is similar to what we discussed on oil, right? I think the scenario is both how much of a jump in prices do we see, but also how long does that jump in prices sustain? And also just putting the size of the move in particular, because I'm sure we've all seen the headlines of European gas prices jumping, depending on when you look at the price, 30 to 40%, right? But when we had kicked off the Ukraine crisis, we saw more of a fourfold rise, in prices. So there has been a response, but it's from a market perspective so far been more muted than at least initially feared. But I think it's the item we focus on is still comes back to the length or the period of time these prices sustain. I think that's still going to be quite key to when we start to see more of an impact on markets and inflation in the case of Europe, or higher import prices or pressure on the external balances for the rest of Asia, or whether this ends up being just a matter of high prices for only a few weeks.
Oh, thanks, Manpreet. Appreciate it's an evolving situation and very difficult to frame views right now, given the evolving situation. And a lot of it will depend on the length and, what transpires. But keeping the broader picture, I know the geopolitical piece is one thing that we're here to cover today, but we also know that tariffs have been the other uncertainty in the global markets, right? We're seeing companies rapidly reorganizing supply chains along regional blocks. How should one look at this about longer term structural shifts in the global trade per se? And according to you, what sectors and geographies stand to benefit from it?
No, that's a really good point, right? I think if you think about policy risk, I suppose what we saw in the US in terms of Supreme Court decision does mitigate some of the pressures, at least in the short term. But I think the bigger trend we're seeing, like you said, right, is from a supply chain perspective, we're seeing some shifts in geographies, a shift to resilience rather than the most efficient solution, efficient solution. But I think from an investor perspective, it sort of highlights two ways we can think about it. I think number one, it goes back to your earlier question on inflation, because if you look back since, let's say, the 1990s, efficiency of supply chains have arguably had a very deflationary impact for the economy and for markets, and that's of course been a positive tailwind. But trying to focus on resiliency is arguably a bit more inflationary, and it comes to the point about mentally preparing for the next sort of cycle to be a little bit more inflationary than what we experienced in the last, let's say, couple of decades. But we discussed obviously how equities and commodities can play a role in achieving that. The second, though, it comes to the point about looking a bit more widely, especially in terms of one's equity exposure, because again, the last, let's say, 2 decades, the bulk of returns in many, or at least large part of those years, have come from US equities. Just that exposure would have taken care of it. But more and more, we believe we're moving to a world where balancing that with a reasonable amount of non-US equity exposure will be important because US markets still offer a lot of opportunities, right? We haven't spoken much about AI given the context, but the US market offers some of the widest investable options in that sort of stream of earnings growth. But if you think about broader supply chains, more diversification, that means opportunities in non-US markets should also rise, alongside. So I think that's the other stance that we think is worth building into portfolios. And to some degree, does feed into our current preference for Asia ex Japan, because that's where we're seeing some of the highest earnings growth, at least over the next 12 to 18 months.
Thank you, Manpreet. That's very useful.
A lot of questions coming in, Pratibha. I would ask you, please. I know that you're getting inundated with questions coming through to your emails, as well as there's some live questions coming in. And just to make the moment a little light, as we go into more serious questions again, one of our investors are saying that they're quite grateful that, they spoke to the relationship manager and investment advisor, and they took an investment portfolio, and it's a diversified mutual fund portfolio, and they're happy they did it. But it's a young portfolio. What advice would you have for them? I think we all know what we have to say to them, but more so in terms of diversification and time in the market. What other advice would you have for more younger investment portfolios and diversified funds? Pratibha, maybe if you could go first, and then Manpreet, if you can add anything on the residual cash positions and where should clients be going?
Thank you, Aisha. I did see that question and it brought a smile to my face. I think you've answered within the question to some extent, because a portfolio with a diversified mutual fund, actually is our base case scenario for a foundation portfolio, simply because it gives you that diversification. Of course, it all depends on what eventually you've invested in, but I think having or building a portfolio that is foundational across different asset classes and diversified across geographies, etc. I think that is a useful start to the portfolio. What we would definitely want to leave with you is that please keep your original call to actions in mind whenever there is volatility in the markets, because the baseline of an investment plan is always around a today, tomorrow, forever plan, which is what we call it, but it's largely nothing but a short, medium, and a long-term perspective to your overall portfolio, where your objectives are taken care of from the length of time as well that they're poised for. So we would suggest that, if, to give you an example, if these are long-term objectives that you're looking to achieve, then the idea is to just leave them untouched. Of course, keep reviewing them so that they're rebalanced to the correct asset allocation, but keep them for the long run, and don't let emotions come in the way of making changes to the portfolio in the short run, keeping in mind what volatility you're going through. I think that's possibly the best advice, but please do keep in touch with your relationship manager and investment advisor, who could look at your particular case, your portfolio, as well as your objectives, and guide you in the right way. But I'll pause and pass it to Manpreet, who probably have a better answer.
Sure. No, maybe I'll just add a couple of points, right? Just to add perspective. So we have looked at, the idea of what happens when you get started and what are the common pitfalls. But number one is, I just want to emphasize a point about time in the markets, because the thing is, look, of course, it is in theory possible that you invest at exactly the wrong moment just before a big bear market, but your risk of sort of experiencing that sort of pain is highest perhaps in the short horizon, but it reduces quite a bit as long as you start extending time horizon, right? And even if you take, an equity index like the S&P 500, as you start extending the years, your chance of experiencing negative returns start to get smaller and smaller till they're not that far away from zero over the years. So I think before you even think about having active views in the market, just getting invested, and more importantly, staying invested is one of the most important things you can do. And to Pratibha's point, having investment focused on goal and around your goals and having clarity over the time horizon, more so than near-term market swings, which I would start from day one to say, look, those are part and parcel of investing, right? It would be unusual for you not to experience volatility. And the second thing is, yes, the diversified portfolio is the best starting point, right? I think active views, it becomes a choice for you over time to what degree you want to start making them yourself, depending on your level of understanding, to what degree you want to rely on others. But actually keeping that diversified starting point is the single most important thing, and making sure that you don't end up with excessive concentrations along the way. I think that sort of framework will hopefully help sustain you on your journey.
Right. Then another, sort of questions coming in more broadly in terms of, the safe haven status of, some of the geographies and with this, current situation, how that is going to be perceived by the markets. Manpreet, any outlook on that?
Look, I think safe havens, I guess markets look at that either from an asset class perspective or a geographical perspective. And look, we've learned this especially through market history. There's never anything as the perfect safe haven asset class or geography or region. Each one goes through obviously its own challenges. But I think you never want to judge a safe haven on a single event alone. I think that's the learning from history. And of course, given our current experience, we're only a couple of days into it. So I think it's ultimately about whether you're thinking geographically or asset class wise. Having a basket, having a diversified approach is obviously always important. But I think this is where having some historical perspective and not making knee-jerk reactions based on experience a handful of days, I think that is actually the single biggest learning I point to when looking at history. Right, we've seen these experiences before. Each one is slightly different. But that's actually the reason why when we think about our own investment process, we rely a lot on making sure we're on top of history, including financial market history, because remind us we have almost all regions, all our markets have faced some sort of crisis in their own right, and I think most end up coming out the other side, better for the experience.
That's useful. Thanks, Manpreet. Pratibha, back to you for some more exciting questions across asset classes, and if you could please come back to currencies as well, because I'm seeing a lot coming through on that too. Over to you, Brent.
Thank you very much, Aisha. In fact, I was actually just scanning through some of these questions and going straight into currencies, actually. So, Manpreet, what are outlook for dollar-denominated instruments? I'll change that a bit. And what are the strategies that we could use to manage FX volatility? I do have a couple of them that I'll combine if that's okay. What is our view on CHF? And also, I think this has been the central case across last year. Should we diversify away from US dollar and into maybe CHF or etc.? So maybe just an overview of currencies. I know you touched upon it.
Yes, no, I think currencies are super topical, right? And I think maybe before I get to the individual currency views, right, I think the overriding, I suppose, approach we take to currency exposure, right, is that it's an asset class exposure in its own right, which comes with its own potential return and risks. So just like any other investment, I think it's important to ensure a certain amount of diversification, right? You want, in the same conversation about stocks and bonds, it applies to currencies to make sure there is not excessive concentration in one or two asset classes, currencies, or views on currencies alone, right? That exposure, that diversified exposure generally helps. And the second is currencies in particular. I think what's unique about them is that especially the more liquid major currencies, they do tend to be more volatile, harder to predict compared to major asset classes like bonds and equities. So actually putting on a little bit of a risk management hat can really help manage one's exposure. So those are two overriding principles, but I think they're important just to bring to the fore to help explain why we hold the views that we do. Now, in terms of the currency views themselves, I think a lot of our sort of focus is still on the US dollar, because that obviously is one side of most sort of currency pairs. And leaving aside, obviously, the current situation we're in, assuming we're right about our base case, then big picture, just like last year, we expect the dollar to continue to get moderately weaker. And that's not a de-dollarization view, that's multi-decade, but just the fact that US interest rates continue to be trimmed away and trim away the dollar's interest rate advantage versus other major currencies, we think will still lead to a weaker US dollar. And that, of course, should benefit most non-dollar currencies, just because of the way currency markets are constructed. But I think in terms of the standouts, obviously, Swiss franc has always been a big area of focus because there's low interest rates. But we do think the Swiss franc, we know it's already strengthened a lot, and some of that is because despite the Swiss National Bank's preferences, inflation rates are extremely low in Switzerland. So that means net of inflation interest rates are still higher than they'd like it to be, and we think that, of course, means the Swiss franc can remain quite resilient. But then, so that's sort of one area, and our forecast, of course, 74 to 75 cents over the next 3 to 12 months. The other, I guess, extreme is currencies like the Aussie dollar, because obviously there's CHF and JPY, good example of very low interest rate currencies. But on the other extreme, dollar has been perhaps looking backwards more on the higher interest rate side, but Australia is an interesting example, increasingly so, where inflation is already perhaps marking a turnaround because of some unique situations there. And that means we think the currency will be actually quite well supported, and in a currency where bonds offer an interesting yield. So maybe those are some of the more extreme sort of currency views out there, but I think the broader thought is really to say, look, we're in a world where we think gradual dollar weakness is sort of the trend. And what we're trying to say within that, how do we take advantage of opportunities like the Aussie dollar, but also how do we make sure that we're well diversified across as many sort of currency views as possible, so we're not taking excessive risk in one currency view at all.
Thank you, Manpreet. Possibly coming back to some asset class related questions, right? And some of them that we have an overweight position on. How will this situation, in your view, affect the emerging market investments or instruments? And just a related question around that was, also, how do you see the regional dollar bonds, again, from an emerging market perspective, an asset class and an investment strategy, given what's going on right now?
Sure. So I think emerging markets, let's talk about equities and bonds separately, because I think the impact is a little bit different. I think if we look at emerging market equities, they're overwhelmingly Asia's the overwhelmingly large sort of share of emerging market equities. And Asia is predominantly an energy importing region. So I think it's sort of very relevant to some of the more immediate conversations, where if this jump in oil prices is relatively temporary, more sort of a matter of weeks, then any volatility could be quite short-lived, and in fact a great opportunity to add. That's still our baseline view, because leaving aside that risk, we still like Asian equities because earnings growth is still quite attractive. But in a weak dollar world, we've seen emerging market equities and Asia in particular generally do quite well. So I think that would be how we think about equities. I think emerging market bonds is a slightly more balanced picture. I think particularly emerging market bonds, the universe tends to be a bit more well distributed across Asia, emerging Europe, Africa, and of course Latin America. So you get quite a good mix of both oil exporters and oil importers. So perhaps the impact would be more specific to issues from certain regions on the oil importing side. But at a broad asset class level, actually that asset class can continue to offer an attractive yield, even if energy or commodity prices broadly remain well supported. So that's why we're overweight on both. And a base case scenario, of course, our preference still would be to use any weakness on either side to add a little more, because we still think the attractiveness of the asset class, our view on a weak dollar, should continue to offer support. I think we just need cognizant of keeping an eye on those downside risks. That's the only scenario where emerging markets could, of course, still face headwinds.
Thanks, Manpreet. That's very, very clear. Thank you. Just going back to commodities, right? I know we spoke a fair bit about oil and we touched upon gold, but there is a question on what we think about silver. The gap between the Shanghai and COMEX, and seems like Asia had a strong appetite for the metal, but how does the Iran development affect it?
So I think I worry less about the difference in prices across exchanges. A lot of that can be temporary because of the supply of physical silver, each geographical location. But unless you're able to trade in both of those exchanges, that's obviously quite difficult and arbitrage to take advantage of. But I think my broader point on silver would be, look, if if gold continues to do well, as we expect, then it's natural for other precious metals, to also do well alongside. And silver, along with a couple of other trades like gold mining equities, are perhaps I'll call it a high beta or a supercharged way of taking exposure to gold prices. But I think at the core, for that 5 to 7% allocation, we still think if the purpose is to buy gold, then buy gold, right? I think that's quite important, because gold is ultimately, that's where we have the central bank demand, unlike other precious metals, and that's where the greater liquidity and the long-term track record of gold as a precious metal. With silver, there are two specific differences, right? One is just how much more volatile it is. And we all like the volatility on the way up, but as we learned not too long ago, the volatility also applies when there are corrections. So that's sort of one additional factor to keep in mind. And second is that silver, of course, is more sensitive to industrial demand, right? It's a much bigger driver of prices than gold. So that's all right in an environment where global growth holds up, but that means an environment where growth is challenged, then it will be harder for silver to outperform gold. So look, nothing wrong in having it as a standalone trade, but like I said, I think we really see gold as being the centerpiece here, and the core allocation portfolios. The rest are ultimately, potentially high beta ways to get similar exposure, but they come with slightly different risks.
Thank you, Manpreet. I have an interesting question, and one that possibly is broader as well. So on the US equities exposure, in light of conversations over overvaluation of the market, especially within the Mag 7, right? Do you think some of these unrests may be a catalyst for correction there and the commencement of a bear run in that space? And I picked on that simply because if you were to look at the S&P 500 and then you compare that with an equal weighted S&P 500, there's a significant difference, right, in YTD performance. So Mag 7 is clearly having the light taken away from it. So what's your view on that, please?
I think actually we're starting to finally see a bit of rotation away from US equity market performance not being driven just by those 7 stocks, which is a really good thing, right? And I think it fits into a view that we do want to retain that overweight on equity, on tech sector equities more broadly, right? I mean, we prefer the semiconductor and internet subsectors, and that's where earnings growth is still quite strong. But of course, in the short term, we've had some positioning challenges, a bit of a correction, which might be a good opportunity. But one of the themes in our outlook that we published in December is that we wanted to own more and more non-tech sectors in the US, besides owning non-US equities, right? And 2 other examples of sectors that we liked are utilities and healthcare, right? And the idea of healthcare, of course, has completely different drivers to technology. And I think, strong earnings growth sort of case on its own right, but we like the fact that it's would benefit from rotation away, or at least a catch up by the broader market. And utilities, again, similar to some degree, though interesting enough, there is an AI tilt to it because of the power demand that's also offering some benefit. So I think that's the way I look at it, that, it's the last 2-3 years were about really focusing on the technology sector, that being the main driver of returns. But we do think we're in a market increasingly so where still owning technology, but owning much more than just that, and owning broader swaths of the US equity market is becoming more and more attractive, because if this rally has to continue, it cannot continue to be excessive concentration in just 7 stocks alone, right? And I think just owning a broader universe, we see more opportunities elsewhere in addition.
Great. I just have a follow-up on that, right? So while that is noted, how best should one invest right now? There are questions around, should we hold cash on the sidelines right now and not invest and wait for the volatility to pass? Or is it a good idea to run a regular savings plan or a DCA, right? The dollar cost averaging right now, rather than just doing lump sum investments, in your opinion, of course.
So I think, look, with the caveat that obviously, everyone's situation and goals might be a little bit different, right? So you can't escape having that individual conversation with your advisor. But at a broad level, look, I'm not a huge fan of cash. That's the emotional knee-jerk reaction. It's perfectly natural, right? In the environments of the kind we're in. But, we've done a lot of work on this in the past. And I think what we've learned is the periods or lengths of time when cash outperforms any diversified portfolio tend to be quite short. right? So as long as the horizon is reasonably long, beyond a handful of months, you're almost always better, instead of cash, defaulting to perhaps the most diversified in portfolio, right? Maybe that's another way to think about it. And also the issue is, even if you, for that short term, cash then draws you into that market timing question. You have to time your exit into cash and also return from cash into other asset classes very well, which, data shows most investors are not able to do that, at least not consistently. So your chance of success through that route are actually very, very small. We'd rather retreat to a super diversified portfolio rather than cash if that's what you're looking to do. So the other question was on
dollar cost averaging, basically.
So dollar cost averaging is often, as long as obviously it suits your time horizon, can be a far more superior sort of approach, right? Because that's actually a scenario where, when it comes to equities, for example, you actually want markets to go down, because by nature of the strategy, ends up buying you less when markets go up by a lot, and then ends up buying much more on the way down. And I think that obviously, from an investment perspective, really pays off in the long run. And second is that it really helps impose the discipline and take away the effort you have to make in terms of trying to time those exact entry and exits into markets. So it has those practical strategy advantages as well. And yeah, that's as a strategy, as long as it suits sort of your goals, we just think that would be a more proven route to a successful investment return over the long run.
Thank you, Manpreet. Just one piece around the current situation, right? The current tensions obviously will trigger increased global defense spending, leading to wider fiscal deficits and the attendant expanded sovereign bond issuance. How do you assess the likely impact of the defense-driven fiscal expansion on crowding out private sector borrowing and overall portfolio risk positioning?
No, it's a great question, right? And I guess if I were to simplify it a little bit, it comes to a question of, okay, is there just way too much, sovereign debt out there, right? And look, I think the concerns to some degree are valid when you look at debt to GDP ratios, or the extent of debt that is, outstanding compared to in stock relative to GDP. But I sort of balance that as well by noting that, look, if you go back, and there's a study that looks at 400 years of what is today's developed market sovereign debt, governments are able to sustain extremely high debt levels for surprisingly long periods of time, right? And I think the more near-term example we experience is when the US credit rating was, for the first time ever, cut from its very highest AAA rating to one notch lower. US government bonds actually rallied in response as a safe haven, rather than the opposite reaction, which is what one might expect. So I think, to me, that's a background sort of risk to keep a watch on. But I would not use that to guide more, at least not the more tactical investment horizons, right? I think the more traditional financial market relationships continue to be very important. The other distinction I'd also make is, there's a big difference in foreign currency and local currency debt. Because you look back over the last 50 years, of course, we've had many experiences of governments defaulting, particularly in emerging markets when debt levels got too high. But that was almost always, I recognize there are a handful of exceptions, but almost always, emerging markets defaulting or not being able to pay back their US dollar debt. While if you think about most major economies today, I think the large amounts of debt tend to be more in local currency, where, look, you run the risk of inflation. I think that's one potential risk from excessive amounts of debt and spending. But arguably, the risk of outright default becomes actually quite small when you're thinking local currency debt only. So look, it's a factor we'll have to keep a watch on, but I'd be less concerned about the crowding out part, or any kind of significant credit risk. I think it's more actually just watching the inflation side. I think that's where you tend to see it show up and how central banks respond to it. And on the point on defense spending, I think equities actually might offer a more near-term solution. So we have to balance that with how much is in the price. Obviously, a sector that's done extremely well, knee-jerk in the last sort of few months. But that's certainly an area where we're paying close attention to see if we can find an opportunity.
I'm going to take one last question, Manpreet. I know we're running swiftly out of time. But there is a question on our view on India. I know we have an overweight stance on it, but market has underperformed. And with the current situation of rising oil prices, could that further dent the sentiment there and see markets pricing lower?
No, the point on oil prices is valid because we know Indian markets have always been sensitive to oil prices, both the equity market as well as obviously the currency, because it is a significant portion of imports and costs. But I think, look, in markets, I think the one thing we always want to keep in mind is there's always a fair price for every scenario, right? And what we're trying to balance it is to say, okay, how much bad news is in the price? You can obviously argue in an absolute level, in theory, obviously there's room for markets to move lower before they bottom. But what stands out to us is the relative performance, right? Relative to the Asia-Japan benchmark, which is how most professional investors like ourselves think about it. Indian equities have already underperformed by the largest amount since the 1990s. So you go back a long way. And Indian equities amongst the institutional, regional investors, EM investors, is arguably already a consensus underweight. And when you tend to see market performance move to such an extreme, usually that tends to offer a great opportunity to position in the opposite direction. It's difficult to time. Obviously, getting the exact bottom can be difficult, but at least it suggests you're starting to get some value. And I think I'd absolutely acknowledge that, a significant, and again, not necessarily a jump, but a sustained high prices can be a challenge, for Indian markets. But outside of that, we do think there's quite a bit of bad news in the price. Oil prices themselves have been grinding higher for a large part of the first few couple of months of 2026. So it shouldn't come as a complete sort of surprise to Indian markets. That's why we still think it makes sense, particularly in a base case scenario.
Thank you so very much, Manpreet. This has been extremely and incredibly valuable, clear-eyed perspective on a genuinely complex situation as we see it. So thank you very much for your time and your views. Just a very quick summary of key takeaways from today. I think I want to bring it back to, going back to our basics in terms of, why we started out on our investment plan, on our objectives, short, medium, and long term, sticking to those with key wealth principles such as diversification, discipline, time in the market, risk versus return, and protection. Keep all of that in mind while we navigate some of these volatilities and keep emotions at bay. But otherwise, I think this has been extremely useful. I'll maybe now pause. Just one piece of information that I want to leave. I know there have been significant number of questions, and some of them have gone unanswered, but we will get to your questions. The team will follow through as well and hopefully answer them in due course. But with that, I'll pass it to Aisha, and if you have any closing messages for all of us. Thank you.
Thank you very much, Pratibha. I think you've covered it pretty well. And I would like to leave, our esteemed clients with the message that, as both Pratibha and Manpreet have repeatedly said, that the core of your portfolios remain for the preservation and growth of your wealth and to meet your long-term objectives. But there are some tactical changes that you can incorporate in your portfolio. So please do remain close to your investment advisors and RMs. And we do realize, and I was seeing the flow of the questioning that was coming through as well, and other queries that we've received through the day is around, clients holding very long-dated bonds. I would make a double line if you're holding very long-dated bonds, or where there's a concentration in specific geographies, then that needs a look at. And then, if you have taken leverage positions and you're a high risk taker, then it's always important to take a look at how your leverage positions are holding, especially where you have cross-currency exposures within that as well. As I said, we are fully operational, fully equipped. Your relationship managers and investment advisors are kept up to date with latest information that is coming straight through from our CIO office. As you can see, Manpreet is right here. And we're keeping our frontline teams very well informed, closely aligned to Standard Chartered views. And we have seen that in the past when, such events unfold, our aim is to get to you first, to talk to you, to understand what your questions are, and to give you feedback and timely and to the best of our ability, most accurate information, so that we can preserve and grow your wealth and be in this journey with you as your trusted partner. With that, I would like to close the call. But as I said, this is not just the first call. We are going to aim to meet you virtually in this fashion. And when time permits and situation permits, of course, we are going to be here for you in a face-to-face environment as well. Thank you very much. Stay safe, stay well, and we are here for you as your trusted partners. Thank you ever so much. Goodbye.
Thank you.